Imagine finding one of the greatest software businesses in the entire world. You buy the stock, you hold it for 5 long years while the company executes absolutely perfectly, and you make virtually no money. That is the exact tension surrounding CrowdStrike right now. Look, there is a massive, almost silent disconnect between the undeniable excellence of their day-to-day business operations and the frankly gravity-defying mathematics of their stock valuation. Because when a stock is priced for unblinking perfection, even a flawless operational track record isn't always enough to save you from a lost decade of returns. 1.13%. Based on our core 5-year scenario framework, if CrowdStrike continues to grow its revenue at a really aggressive 22% annualized rate all the way through 2032, the base case annualized return for the stock is a staggeringly low 1.13%. We're going to unpack exactly how that math works in just a few minutes. But to truly understand this valuation reality check, we first have to understand what's driving the underlying economic engine and why the market awarded them this massive premium in the first place. To grasp the magnitude of this disconnect, we've got to look at how CrowdStrike actually makes its money and why it commands so much respect from the world's largest enterprises. This isn't just another tech company selling a nice-to-have little widget. It's literally a structural cornerstone of modern enterprise security. They generate about 95% of their revenue from highly predictable, multi-year SaaS subscriptions. But what do those subscriptions actually do? At its core, CrowdStrike provides endpoint security. Every laptop, mobile device, server, and cloud workload connecting to a corporate network is an endpoint. Basically, it's an open door for a cyber attack. CrowdStrike acts as the elite security guard at every single one of those doors. But what really matters here is why the biggest organizations on Earth are entirely standardizing their security on the CrowdStrike Falcon platform rather than piecing together different software from different vendors.
The difference between the past and the present is pretty stark. Legacy security meant running siloed, clunky software agents. Think back to the old days of corporate antivirus, right? It choked your computer's CPU, it required constant reboots, and it forced security analysts into this manual, highly stressful triage mode. It was fragmented, slow, and left massive blind spots. You paid separate fees for a firewall, an antivirus, and a threat hunting tool, and none of them even talked to each other. CrowdStrike solved this nightmare with a brilliant piece of engineering: scalable, secure consolidation. Instead of 20 heavy programs, they deploy a single, super lightweight agent. It sits quietly on the machine with minimal overhead, while natively delivering over 33 different modular security programs directly from the cloud. It doesn't rely on outdated lists of known viruses. Instead, it uses behavioral AI to detect anomalies and contain threats at machine speed. If a totally unseen piece of malware tries to execute a weird command, the AI just stops it instantly. So enterprise buyers aren't just buying a tool, they're buying an end to alert fatigue, complex integrations, and network blind spots.
And that technology translates directly into a near unassailable economic moat built on 3 very distinct pillars. First, high operational switching costs. Ripping out CrowdStrike across 10,000 servers isn't just a simple software update. It introduces massive downtime risk and leaves the company totally vulnerable during the transition. It's kind of like trying to replace a patient's nervous system while they're walking. This friction is exactly why CrowdStrike maintains a breathtaking 97% gross retention rate. Once they're in, customers effectively never leave. Second, they possess immense indirect data network effects through their security cloud. Their threat graph processes trillions of events weekly. If a brand new threat hits a single customer's server in Tokyo on a Tuesday morning, the behavioral defense rules are updated and pushed out globally in real time. Every other customer around the world is protected within seconds. Adding one user mathematically increases the defensive strength for everyone else. And third, their massive runway for expansion. We're looking at a total addressable market projected to expand from $149 billion in 2026 to a staggering $325 billion by 2030. They're using their cash flow to make strategic acquisitions like SGNL and Seraphic, constantly adding more modules to that single lightweight agent. By consolidating all these separate markets into one unified platform, they command absolute pricing power. So the underlying business is an absolute machine. It's one of the most structurally sound, highly defended software businesses ever built. But that brings us to the central conflict of this entire explainer, the tension that makes this stock so incredibly difficult to navigate. The clash between elite operational execution and a stock priced for absolute, unblinking perfection. On one side of the ledger, you've got the fundamental reality of the business. You have a Rule of 40 score, which measures growth plus free cash flow margin, sitting at 59. Anything over 40 is considered elite in enterprise software. 59 is just rarefied air. You have that locked-in 97% retention and a 5-year historical revenue growth rate of over 40%. It's a dream fundamental profile. But then you look at the price tag the market has assigned to that excellence.
Heading into their recent earnings, the stock traded at a trailing price-to-sales multiple of roughly 43 times and a forward non-GAAP price-to-earnings multiple of 148 times. Let me put that into context for a second. A 148x forward PE doesn't just ask for continued growth, it actively demands flawless future execution. It assumes nothing will ever slow down, competition will never erode margins, and macro tightening will never delay a single sales cycle. Historically, when SaaS companies trading at these nosebleed multiples experience even a slight deceleration, say dropping from 35% growth to 25%, the stock doesn't just stall, it corrects violently. The multiple compresses, the business can still be compounding, but the stock gets cut in half because the premium just evaporates.
Which leads us to the billion-dollar question that defines this investment thesis. Can the fundamental execution outrun the mathematical reality of its valuation? Keep that tension at the very front of your mind, because we're about to look at the absolute latest financial evidence to see if the company is currently justifying this staggering premium. To answer that, we turn to the hard data. On August 26, 2026, CrowdStrike reported their second quarter earnings for fiscal year 2027. The market was watching closely, waiting for any sign of weakness, any crack in the armor that would justify a sell-off. But instead, the numbers they delivered showed massive top-line acceleration that immediately caught Wall Street's attention. The metric that matters most for a SaaS company is annual recurring revenue, or ARR. It tells you exactly how much predictable, locked-in cash is flowing into the business over the next 12 months. CrowdStrike grew their ending ARR by a highly impressive 25% year over year, jumping from $4.66 billion in the same quarter last year to a massive $5.84 billion this quarter. They easily beat analyst expectations on both the top and bottom lines. Total revenue for the quarter hit $1.47 billion. But it wasn't just about revenue scale, it was about the efficiency of that scale. They generated a Q2 record of $377 million in free cash flow, representing a highly efficient 25.6% free cash flow margin. They are basically throwing off cash while scaling at a quarter-century growth rate. But hidden inside those headline numbers was a metric that truly shocked the market: 51%. That is the year-over-year acceleration in net new ARR added during the quarter. They added a record $332.8 million in net new recurring revenue in just 3 months. This means their growth isn't just sustaining, it's accelerating in absolute terms. During the earnings call, CEO George Kurtz attributed this explosive demand to what he called the Mythos moment. Look, with advanced AI models now automating vulnerability discovery at machine speeds, malicious actors can find network exploits way faster than human defenders can patch them. Enterprises are waking up to this reality and are scrambling to deploy AI-focused cybersecurity solutions to fight fire with fire. CrowdStrike, with its massive data advantage, is catching that spending wave perfectly.
The market's response to this evidence was swift and forceful. Following the earnings beat and an upward revision to their full-year guidance by management, the stock surged 12.6% in after-hours trading, violently reclaiming the $212 mark and breaking past key technical moving averages. Institutional money clearly bought into the AI acceleration narrative, pushing the valuation multiples right back to their upper downs. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
So the quarterly momentum is undeniably strong, and the management team continues to execute masterfully. But before we build our 5-year valuation scenarios, we really need to zoom out. We need to look at a synthetic scorecard of CrowdStrike's overall business quality to see the full, nuanced picture of what an investor is actually buying. This scorecard distills the fundamental reality of the company. Revenue quality is a perfect 10 out of 10. You literally cannot ask for better visibility than 95% SaaS subscription ARR with 97% gross retention. Their track record is a 9 out of 10. George Kurtz and his team have a long, unbroken history of setting conservative guidance and then beating it quarter after quarter. Their market position is also stellar, scoring a 9. They're routinely named the undisputed leader in endpoint protection by major research firms. Financial health is similarly robust. They carry over $5 billion in cash with very low debt. But then we hit profitability, scoring a surprisingly low 7 out of 10. While their free cash flow generation is phenomenal, their actual GAAP net margins are continuously dragged down by massive stock-based compensation, or SBC. Recently, SBC sat around 21.5% of total revenue. That is real equity being handed out to employees, which steadily dilutes the ownership stake of everyday shareholders. Overall, we arrive at a blended qualitative score of 8.6 out of 10. The conclusion is clear. It's an elite, generational business, but it comes with heavy ongoing dilution and an excruciatingly expensive price tag.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Premium also gives you Portfolio Watch to monitor your portfolio and flag important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, now we arrive at the most critical part of this analysis. We're going to build a 5-year valuation scenario framework. This is where the mathematical tension between a flawless business and a steep valuation truly reveals itself. We are going to project the business out to fiscal year 2032 and apply rational market multiples to see exactly what kind of return an investor can expect from today's prices. Now, before we hit the numbers, I have to state this very clearly. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. To ensure our math is completely transparent, here are the starting assumptions. Our baseline share price is $189.18. We're starting from the exact midpoint of management's FY27 revenue guidance, which is $6.001 billion. We're assuming a starting free cash flow margin of 33% and a split adjusted share count of 1.044 billion shares. We are modeling out 5 full years to fiscal year 2032, applying a weighted probability model, a 50% chance for our base case, a 20% chance for our high case, and a 30% chance for our low case. Let's look at the specific operational conditions required for each of these scenarios to actually play out. The crucial step is understanding the underlying story behind these numbers. In our high case, which we assign a 20% probability, CrowdStrike aggressively capitalizes on the AI security spending wave. They maintain hypergrowth, driving a 28% compound annual growth rate in revenue, reaching an astounding $20.6 billion by 2032. Their free cash flow margins expand to 37% as they realize immense operating leverage. In this scenario, because growth remains so exceptional, the market is willing to maintain a rich 45 times free cash flow exit multiple. The implied future price is $334.76, yielding a 12% annualized return. It's a great outcome, but it requires absolute perfection for 5 straight years. In the low case, a 30% probability, the macroeconomic environment tightens further. They face intense pricing pressure from competitors, slowing their revenue growth to just 15% annually. Margins contract slightly as they're forced to spend more on sales and marketing to acquire customers. The market stops treating them like a hypergrowth unicorn and applies a standard enterprise software multiple of 25 times free cash flow. In this scenario, the stock plummets to $77.64, and you lose over 16% annualized. But I really want to focus deeply on the 50% probability base case. In this scenario, the company executes brilliantly. Revenue grows at a highly respectable 22% a year for 5 straight years, hitting over $16.2 billion in scale. Free cash flow margins expand steadily to 34%. By any operational standard, that is a wildly successful corporate run. But as the business reaches this massive scale, its growth rate naturally matures. The 40% growth days are mathematically behind it. Consequently, Wall Street will re-rate the stock. The valuation multiple compresses from its historic highs down to a matured software level, comparable to our stalwarts like Palo Alto Networks or Fortinet Trade, landing at roughly 38 times free cash flow. When you apply that 38x multiple to the billions in cash flow they're generating in 2032, the math outputs an implied future share price of exactly $200.09. That represents a total cumulative return of barely 5.7% over a 5-year holding period, up from our $189 baseline. That is exactly where our 1.13% annualized return figure comes from. This is the silent killer of high multiple investing. The company can execute brilliantly. The management team can do everything right. The products can completely dominate the market, but multiple compression acts like gravity. It ruthlessly crushes the returns for the investor who buys at today's peak premium. The fundamentals grow, but the multiple shrinks, and the stock price goes absolutely nowhere. And remember, that sobering base case assumes that things generally go right, and the company scales to $16 billion smoothly. We have to pivot now and analyze the concrete execution and competitive risks that could very easily impair this thesis and drag the stock down into our punishing low-case scenario. These are the structural threats you absolutely need to monitor.
First, and perhaps most critically, is the ongoing Delta Airlines litigation over the July 2024 software outage. A faulty CrowdStrike update grounded Delta's fleet, and Delta is now seeking roughly $500 million in business interruption damages. While claims of gross fraud were rightfully dismissed, the negligence claims are still proceeding. This is a massive systemic risk, not just for CrowdStrike, but for the entire software industry. SaaS contracts are built on limited liability clauses, usually capping damages at the cost of the software itself. If Delta manages to bypass that cap and hold a vendor responsible for hundreds of millions in indirect downstream losses, it creates a terrifying legal precedent. It alters the fundamental unit economics of enterprise software. Second, the competitive threat from Microsoft. Microsoft is aggressively bundling its own Defender security product into enterprise Windows licenses. For massive Fortune 500 companies, CrowdStrike's superiority easily justifies the extra cost. But in the highly price-sensitive middle market, many chief information officers are looking at their budgets and deciding that Microsoft's good enough free bundled software is preferable to paying a premium for CrowdStrike. Third, there's genuine keyman risk. At a moment when frontier AI defense is critical to maintaining their lead, their global chief technology officer, Ilya Zaitsev, recently departed to launch a venture fund. Transitions in elite technical leadership always introduce execution risk. And finally, macroeconomic IT consolidation. As economic uncertainty persists, large enterprises are subjecting major software purchases to intense scrutiny. Deals that used to take 3 months to close are now taking 6 to 9 months, which threatens to delay ARR realization.
This quote really synthesizes the entire intellectual and emotional tension of our analysis. CrowdStrike is a highly disciplined, visionary security consolidator with a phenomenal moated product. But the stock market is a forward-looking discounting mechanism, and it has already given them full, exuberant credit for that excellence. The fundamental operations are exceptional, but they are fully, completely, and perhaps dangerously priced into the stock. So if you're holding or watching this stock, this is the single metric that matters most going forward: sequential net new ARR growth. Because they're trading at such a stratospheric forward multiple, any deceleration in how fast they add new recurring revenue from one quarter to the next will instantly trigger the multiple compression we mapped out in the scenario framework. They are on a treadmill. They literally have to keep accelerating just to tread water on their current valuation. So we arrive at the final question that resolves our central conflict. Is standardizing on the world's best security business worth paying the steepest market premium? Well, as an enterprise CIO tasked with keeping hackers out of your network, the answer is unequivocally yes. You buy CrowdStrike. But as an investor tasked with generating a return on your capital, you have to decide if you're willing to risk 5 years of dead money while you wait for the fundamental reality of the business to finally catch up to the sheer gravity of its price. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.